Hello, everyone. We wanted to take a quick moment to thank you all for joining us today. This podcast was recorded and is made available to you by Whitley Penn LLP and WP Wealth LLP solely for informational purposes. The information, views, and opinions expressed in this podcast are general in nature and are not intended to be construed as the provision of financial or investment advice by Whitley Penn or WP Wealth. The information discussed in this podcast is accurate as of the day it was recorded, but may then become outdated over time. Please feel free to contact us if you have any questions, comments, or concerns in regard to the content presented. Thank you again for tuning in, and we hope you enjoy this episode.
Hey, everybody. Welcome back to our next edition of Whitley Penn Talks. I'm Tom Rein, and Director of Wealth Management at Whitley Penn, and I'm joined with one of my associates, Matt Magee. I hope that you have taken an opportunity to listen to some of the previous podcasts that we've done at WP Talks through our financial planning group. So we've got an interesting topic today. I think it's interesting. And so welcome, Matt. Let's kind of get into this.
Yeah, thanks for having me. All right, let's get started with it. We've talked a lot about the market in the past couple episodes. I wanted to start today's conversation off more about client and investor expectations for the foreseeable future. I'd love to get your take on that.
Yeah, it's a great question. You know, when we visit with prospective clients, and it's interesting because a prospective client can come from a lot of different backgrounds. It may be the first time that somebody has reached out for professional advice as it relates to their wealth or investments, or it may be a situation where somebody has had prior experiences, either good or bad. Typically, they're probably not satisfied because they're willing to have a conversation with somebody else. But I will tell you, generally, most folks would come to that relationship with an expectation about some assumed level of returns that they should expect in the market.
Hmm.
And I think a lot of that comes from the fact that, you know, we're inundated daily with information from financial media, both in, you know, television and print and podcast about the market. And, you know, a lot of investment focused groups, really all they have to sell is the investment. So, you know, their theme is going to be how we maximize the rate of return for a portfolio at any given point in time. And so a lot of individuals have that kind of stuck in their mind that, you know, whatever the Dow is yielding this year, or the Nasdaq or the S&P, or whatever the perceived historical rate of return, that's kind of their benchmark for evaluating whether they've had a successful investment um, uh, journey, if you will. And I would tell you, if you asked most people, you know, what should you expect to receive for your equity part of your portfolio? And I think generally they would say, oh, you know, about 10%, which, you know, the S&P, that's a little high. I think the S&P is somewhere maybe 8.5 to 9.5% historical. But there was a time when probably the S&P yielded about 10%. And then from bonds, they would say long term, probably about 4.5 to 5%. And would think of bonds as an asset class that would generate some stream of income in retirement, you know, in a time when they're looking to supplement Social Security or maybe some other sources of inflow to manage their cash flow needs for lifestyle. So I think at 30,000 feet, most investors, not all, those that have experience or a little more knowledgeable would understand that to be different. But most investors, I think that's probably a realistic assumption that's what they would expect to receive.
Absolutely. To take a step back of why investors want that sort of return from equities, can you talk a little bit about real versus nominal returns, the effect of inflation, and why it's important to have that equity exposure?
Yeah. So Inflation is a huge component of the financial plan. I'll add one more caveat to the prior conversation, and that would be if an investor, there's a mentality out there that if the market's going to give you X,
Hmm.
then, with just a little bit of effort, you should be able to exclude those bad companies in a broad index called the S&P and generate an effective rate of return that's superior than the index. So anything below that is somehow failure or poor job. The reality is that most investors over their investment career underperform the benchmarks because they're always changing, chasing trends, selling at the wrong time, buying at the wrong time, generating a bunch of fees and expenses. So the reality is their experience is sub index or broad market rate of return, but yet they would define that as a unsuccessful investment experience. But in reality, that's the experience that they generate. To your second question, it's really important uh, to generate a rate of return in your portfolio that's significant enough that outpaces inflation. In other words, it keeps the purchasing power of your money consistent through whatever time frame, and that typically is retirement, so that you're not underperforming inflation and eating into principal prematurely, which creates the snowballing effect of distributions out of your accumulated assets. And then you're just running against the clock. Am I going to outlive my balance, or am I going to, or is my balance going to be adequate enough at my mortality so that I'm able to live the lifestyle I need through my entire retirement years? And we know that inflation over time changes. It's been pretty consistently low for the last many years. Certainly since the financial crisis in 08, 09, we've had this kind of subpar inflation where the Federal Reserve has been trying with lots of different policy tools to get inflation up to their target of 2%. But even in low inflation, the purchasing power of dollars have changed materially, in the last 10 or 20 years.
Yeah.
Um,
Yeah. One of the things you hit on when you answered the first part of that question was overactivity. That's definitely something I've seen a lot of in my couple months here. And is that activity from a lack of a financial plan? Like, what would you attribute that to?
in the recent, historically, I would say generally, and we saw it back in 08, 09, we saw it back in the tech bubble in 2000. People have um, uh, their attitudes towards risk. While times are good and the economy and the market are healthy, they believe that they have a tolerance to risk that when we get into an extreme environments, they realize it was misappropriate.
Hmm.
And so they get caught up in a situation where, and markets get chaotic at times, and they misjudge their willingness and ability to stay in their seat, as we've mentioned in previous podcasts, and they react to the environment instead of recognizing that sometimes there is dislocation in capital markets that create extreme environments, and they're usually temporary, but yet they're not willing to wait it out to recognize fair price establishment back with normal trading activity. So there's that, and I think if you kind of look at and read a lot of the articles out there right now about during the COVID crisis and shelter in place, and the fact that there's no sports or sports betting, that there is a part of the population that have turned to the stock market as a form of entertainment or gambling. We see that if you look at some of the major custodial firms, Schwab and TD Ameritrade and Fidelity and some of the other discount brokerage firms, although every custodian is a discount broker today, the
Hmm.
number of retail accounts that have been established over the COVID time period is significantly higher than normal trends, which kind of gives a little bit of validity that there's some new players in the market who are there primarily to create transactions in the trade, almost as a fill-in for the void they're experiencing in other areas of their life at this point in time.
Yeah, I mean, there's a lot that goes into that from you hit on risk assessment, personalities, kind of balancing those two. I mean, in this low interest rate environment that we've been in for the past decade plus, it looks like we're going to be in it for the foreseeable future. Should investors take a strong look at their bond allocation, given that they're not going to get very strong returns from those? What do you think about that in a typical 60-40 and kind of balancing that risk with the need for returns?
Yeah, so the fundamental basis of an asset allocation is to accomplish some stated rate of return that meets uh, your particular return needs in a real return sense. So in other words, after inflation, and then secondarily, and probably every bit as important, is with the understanding of what level of risk or volatility comes with that. So traditionally, and I know there's a lot of debate out there right now, whether asset classes are acting like they have historically. And what I mean by that is non-correlation of certain asset classes. So when you talk about correlation or non-correlation, what you're talking about is the movement of one asset class in relations to another given a current environment. A non-correlated asset class would be one that if, let's say, stocks were going higher, and money was flowing there, it maybe was coming from somewhere else. So another asset class was actually going lower at that time, and that's a non-correlated. What we've seen in the last many years is that assets seem to all be moving in the same direction. Um, Pre-COVID, pre the economic shutdown and the effect to valuation of assets at that time, you were hard pressed to look at an asset class that wasn't at or near all-time highs, and that would be true for stocks, and it would be true for bonds. It was probably true for real estate. Um, Maybe commodities were an exception to that, but there's different reasons for that. So you're scratching your head today about, as you build a diversified allocation that is designed to accomplish some stated real rate of return and some characteristic of risk management. Bonds typically is a big part of that 60-40 equation. It represents 40% of the asset allocation, which is generally appropriate for those emerging into retirement and maybe even in retirement, given the size of their portfolio. And I don't think that zero or low interest rates change that, but I think our expectations of what the bonds will do for you probably has changed. I think bonds are still going to be deemed, or the marketplace still deems them as a safer asset, less volatile asset than equities in a bad environment. But yet, I don't think one could expect any type of meaningful return from those bonds. So should you avoid bonds and exclude them from your portfolio? Well, in doing that, you've probably increased the expected rate of return, but you've also increased the level of volatility significantly. And again, that may be a situation that an individual investor can't live with and would give them significant heartburn if we got back into a volatile environment, and would not like the results of that. So, I think bonds still play a role. You want to be really thoughtful about
Hmm.
the type of bonds you own, the duration, the quality, but they're primarily in a portfolio now for volatility management, not necessarily for enhancement to return.
Yeah, that makes sense. I mean, you definitely alluded to the importance of a financial plan, and expected rates of return are a part of that financial plan and accomplishing those goals. Um, for an investor that might be listening, what are some other things that they should definitely be taking into consideration?
I think today with so much of the uncertainty, I think, from a comprehensive global kind of wealth management standpoint, you want to be really thoughtful about their liquidity. We typically you get into real difficult times when there's constriction of liquidity. We saw that in March when when the debt markets froze up and people do extreme things. Individually, you could protect yourself more than the marketplace in general by adding a little more liquidity than you typically would. If you've got upcoming expenses in the horizon that are pretty predictable, you want to make sure that you've set funds aside in a no or low risk environment to handle those, so that you don't get stuck in an environment where you have to sell assets at an inopportune time and suffer real significant valuation declines. I think also just recognizing your level of debt that you hold, your free available cash flow on a monthly basis, how much of your inflow is committed to fixed obligations,
Hmm.
and you want to reduce that percentage as much as you can to create more flexibility and freedom. And again, just making sure that your time frame for your accumulation of assets, the risk that you're willing to apply to those assets are consistent. And if they are, if you've done those things personally, then it doesn't mean that you're not going to feel apprehensive or anxiety if we get into another extreme environment, but you give you maybe a little more confidence to not have to react in it, which I think ultimately will help prevent making a permanent mistake.
Yeah, that makes total sense. I mean, everything you just hit on there is really around optimizing for quality of life and their financial situation, and not just a rate of return. Uh, when do you really see like newer investors kind of, when does all of that click for them? Is it after a volatile time like we saw in March, or is it just hearing the story and seeing the plan over years? Like, when do they finally stop asking so much about, I guess, returns and more goal oriented?
Yeah, and I think everybody's different. Certainly, to have had life experiences and made mistakes, and see as time goes by, things become much clearer. Helps. I mean, if you're an intelligent and certain level of financial smarts, you learn from lessons, you don't continue to make the same mistakes. But I think also working with an independent fiduciary that is really plan focused and really goal focused and does a good job of explaining what this process is all about, how we will suffer periods of volatility, some more extreme than others, but that capital markets go higher over time.
Hmm.
And as long as you're willing to sit in your seat and maybe even be more aggressive during the environments when there's more volatility, then you actually enhance your rate of return. So being bold when others are fearful, and being more cautious when others are overly bold, I think is will serve investors well. But I think everybody learns it at a different pace. But typically, experiences certainly help reinforce the ultimately you know the the true understanding of long-term wealth management.
Yeah, I like it. All right, let's wrap up with a couple easy questions. I was curious, if you couldn't invest in equities today, where would you be putting your resources?
You know, in the short term, I think it's clear that equities are the place to be. And I
Hmm.
say that just there's so much energy and money flows into equities, coupled with the fact that Treasury has committed, and they're talking about another round of stimulus. The Fed has given their verbal assurance that they're going to be in the game. It's hard to ignore all that liquidity making its way into a zero rate environment and naturally flowing to risk assets, which typically are equity. So certainly in the short term, barring some information that we don't know today that's materially different, I think equities continue to ride higher, at least in the short term. Beyond that, I'd be hard pressed to make long-term commitments, either in certain types of real estate or more speculative bets. I think buying bonds or adding materially to bonds is problematic, given the interest rate environment, the unknown status of the economic growth coming out of the COVID shutdown. But I think the things that you could do that would be impactful is really understand your liquidity needs, and if you're shy on some of your liquid safe dollars, maybe restoring that, or putting some additional safety aside. Certainly looking at paying down debt and trying to create more flexibility on your demands on your monthly cash flow, I think, are really valuable investments or uses of assets today. I think investing in yourself. I think the world is going to look different as we come out of this. We've learned a lot about how business is conducted, and I would continue to invest in yourself to put yourself in a position to be successful in whatever your career path might be into the future, whether it changes materially because of COVID or whether
Hmm.
it enhances. But I think those are good investments that you could make. I'd be cautious about making illiquid longer term investments given the amount of unknown and uncertainty. If you put money into something that is illiquid or hard to get out, and the rules change or the facts differ, you may be disappointed in the outcome on that. So stay pretty liquid. Capital markets and equities are certainly going to be liquid and probably are going to continue to move higher, but also just making decisions that put you in a better position and more protection, I think, are the things that I would recommend at this point.
Yeah, that solid answer. All right, so we're roughly 4 months into COVID. I mean, what have you been reading or watching this summer?
Yeah. Not my typical stuff. A lot of my Netflix and other programs were delayed
Yeah.
production, so
Hmm.
some of my favorites are not on there, or we've power watched them already, unfortunately. And, the reality is there's been so much information out there from an industry perspective on what we do and what we talk to our clients about every day. Been doing a lot of reading of information about Fed policy, tax policy. Obviously, so much has changed in tax law. The Treasury. Obviously, we're right in the middle of a political cycle. There's social unrest. So really, really real-time headline. What's going on in the world information is there's so much of it right now. It's been kind of all consuming, and so that's largely what I've been listening to and reading, and look forward to getting to a point where things are a little calmer and maybe we can get back to some of the old routines that kind of filled our non-technical side of our brains and our non-business sides, and more personal and pleasure. But unfortunately, that's been largely what I've been looking at and listening to over the last several months.
Yeah, I've definitely blown through all of my shows. We went back and started watching Lost for the first time. I had no idea that there's like 25 episodes in the first season, so we're good for at least a month or two.
There you
Uh,
go.
all right, I will take the last question. So, where can people find us? They can find us at WPWealth.com. We now have a podcast page at WP Wealth, LinkedIn, Apple Podcasts, wherever you typically listen to your podcast. And I appreciate you listening. Thanks.